pense qu'on va pouvoir commencer.
We're going to start this session. Good afternoon, ladies and gentlemen, and welcome for this session on the Impact Barometer, launch of the Impact Financing Barometer. I supervised the work on the barometer with the contributors, but also the steering committee members, whom I would like to thank very warmly. I would like to thank each and every one of you as well. Thank you for attending this session. I will be very concise for this introduction because I think we have a lot of ground to cover with the different speakers. Just very briefly, to set the scene, what is the Impact Finance Barometer? Well, it is a report that we publish every year at Convergence, and it basically gives the main key figures and trends on impact finance and financial inclusion in France, in Europe, and across the globe. The goal is to give the main trends at global level. And this year, the main topic chosen by the steering committee and that chose the editorial line for the year decided to tackle and to cover the topic of resilience in the light of what we call exogenous shocks. By that we mean all the shocks, all the risks that can, in one way or another, destabilize a sector. So they can be of political nature, conflicts as well, climate conflicts, etc., etc. So the theme is the one I just mentioned for this report, and this is the theme for our discussion today. And as I was saying, I really wanted to warmly thank all the people that contributed to drafting this report, namely the steering committee members, the different contributors to the barometer, and also our partners. Because if it wasn't for you, we would never have been able to put this together. Very briefly, very quickly, I'm going to introduce the different speakers for this round table. I'll start with you, and then I'll finish with Lucia. So let's start with you, Raphaël Ara. You're a general director and co-founder of XAPA. We also have with us Jérôme Coursier, senior advisor at KPMG. Thank you very much for taking time to be with us today. We also have Pauline Becquet, who's General Director for Finance for Tomorrow. And we also have Philippe Guichandu, who's Director of Inclusive Finance Development at Crédit Agricole Grameen Foundation. And we also have Alain Lévy, who is in charge of financial inclusion in Asia and South America at BNP Paribas. Thank you very much to all of you for being with us today. I think it's going to be very interesting. And in order to moderate this session, we also have Lucia Spaggiari. You will be the MC for this session. You are the Innovation Director at MFR Microfinance Ratings. You will be the MC for this session. I won't take up too much of your time. I'm going to give you the floor. But to introduce the discussion, I wanted to ask you one question to kick off this debate. Talking about financial inclusion, and you're going to be talking about a platform, Atlas, how can the sector of financial inclusion resist the recent crisis based on the data that you're going to give us regarding the Atlas platform? This is my question to you. Again, thank you very much for organizing this session. I wish you a very interesting and fruitful session and discussion. Thank you. Thank you, Luca. I am delighted to be with you today. My name is Lucia Spaggiari. I work at MFR, rating agency. Here's a little bit of a musical interlude for us. Let's start. What I would like to tell you today, alongside my colleagues from the panel, we would like to tell you about the key trends that we have been able to see at the Atlas platform managed by MFR. And I'm going to focus on financial performance and risk management, because my colleagues Alain and Philippe are more specifically going to focus on social performance and the climate change related risks. The trends I'm going to talk about are averages. Of course, there are different personal and individual stories behind these trends, but I'm going to really give you the key trends that we have been observing in the past few years, specifically on the financial inclusion sector, and then we will focus later on the impact finance. Let's start with good news. First, starting 2021, the financial inclusion sector has started to grow again. This is the first good news of the day, even if the credit risk has been hit by the COVID-19 crisis, more specifically in 2020, as you may see with the arrow upward and the ratio. So the portfolios of customers that are late by at least 30 days in their payments. However, we can see an improvement in the structuring of the portfolio starting 2021, with at the same time a decline in the ratio of unpaid loans. So all the loans where financial incentives had to either extend the maturity or reduce the payment terms in order to make the loan more affordable by customers. What's interesting to note in this restructured portfolio ratio is the fact that, first, we have never restructured as much as we have in 2020, both in mainstream finance but also in microfinance. And it's not easy to restructure, so this is the first highlight the capacity, and it's going to be really important also in the future crisis when we are confronted with future exogenous shocks. Our sector is now able to manage these crises with exceptional measures. So the capacity not only to restructure is something that needs to be noted because it's quite easy, but to reabsorb the restructured portfolio in a short period of time. As we can see in 2021, the decline in this restructured portfolio, which was quite worrisome initially, that were reabsorbed quite quickly. So these are two good news. We have started to grow again, and we have better managed the credit risk starting 2021. With better growth and better quality in our portfolios, we have been able to recover the portfolio yield, even if we haven't been able to get back to the pre-crisis level. Because what do we ask our portfolio? We need the capacity for a portfolio to generate revenue with which you need to be able to cover your financial services costs. And this ratio is even more important in the microfinance sector than in the mainstream finance sector, because the ratio and fees are quite expensive in microfinance. In 2020, a Filipino institution told us that according to them, the fact that they were not able to clear as many credits as they have in the past in 2020, this opportunity cost in portfolio yield that was missed was 4 times higher compared to the credit or provision risk. So this is an important measure for the reliability of financial institutions. And thankfully here we can see that between 2021 and 2022, this ratio has been improving in most regions. Now, talking about the profitability of financial institutions, it is slightly improving from 2021, even if, again, we haven't gone back to the pre-crisis level. However, the fact that in the past 2 years, financial institutions that offer inclusive finance have not been able to obtain the same level of profits as in the past, we are starting to see the negative impact of capitalization of microfinancing institutions. So in 2021, we have seen a decline in the solvability ratios, so equity compared to the equity to assets ratio, so the cushion to absorb shocks compared to your debt, and this margin has declined starting 2021, which poses a bigger problem in terms of average solvability. So again, these are averages. Averages synthesize different trends, but behind these averages, you have different financial institutions that have had very different situations, of course. And behind that, you have a credit portfolio. We have households, vulnerable people. So you have very important stories behind these trends. But there's one thing I would like to share with you is that there's a specific segment behind this trend of 15% of financial institutions that are particularly at risk because their credit risk is high and their solvability risk is high. So they can expect to have issues and challenges, and they don't have enough resources to tackle these challenges. These institutions are numerous, especially in sub-Saharan Africa, unfortunately, and in small-scale institutions. Hence, the fact that we need to remain vigilant at all levels in the risk management and to target as much as possible with the institutions that deserve capitalization because they really have this capacity to bounce back and to reach out to vulnerable people. This is it for the presentation of the barometer. I remain available if you have any questions. Now, I'd like to give the floor to Alain and Philippe from the financial inclusion sector. You have the privilege of working with your clients in emerging countries on a daily basis. You are in direct contact with institutions that offer services to vulnerable populations in emerging countries. So what is your point of view on their financial performance and on the way that they have been able to manage climate change? Good afternoon, everyone. Thank you, Convergence, for inviting me to partake in this roundtable. For microfinance institutions and the performances of these institutions, Lucia, the graph that you showed us is very much in line with the institutions that we are funding in emerging countries on the increasing risks on credits that were restructured and on the decline of profitability that was very significant. And most of these institutions had losses in 2021. So these institutions are less profitable. This is for the financial side of things. Now, we need to also bear in mind that there were things that were very positive. So, as you said, we had restructuring, so restructured loans. However, in the institutions that we follow, we haven't heard any about disrespectful methods of debt collection. Because I think now there are more mechanisms to protect clients, and even more in the microfinance sector, because the social aspect is even more present and prevails. So there was no hard collection, no hard debt collection. Everything was quite smooth. And most people would say that these institutions didn't do any debt restructuring, but now they've started doing it to help their clients. As for the and debt rescheduling, at BNP Paribas we have started a performance analysis. We've been doing microfinancing and this type of and offering these type of services for over 20 years, but we wanted to take stock, and we resorted to the work of a PhD. And we've selected different indicators. So we started this analysis that started in 2021, the end of 2021, 8.1 micro creditors, mainly vulnerable clients in Asia. 97 of these customers are women, and most of them focus on are living in rural areas, so people who don't have access to a bank and therefore have trouble having access to a loan. And 79% of these customers are living in rural areas. And here, this is almost impact finance, but we can see that out of this 8.1 million micro borrowers, allowed us to either preserve or create 1.3 million jobs in 2021. 1.3. So it shows how resilient impact finance is to these exogenous shocks. Now, one of the other assets of microfinance in its social mandate is the fact that there were a lot of support time offered to our customers. 4 hours, 30 minutes of support offered to each micro borrower. So it's very intensive, especially given that these support programs range from how to create a business plan to prevention measures against high debt ratios. And in 2021, we've offered trainings on health, prevention measures, etc., more specifically on COVID. And in terms of quality, most financial institutions have implemented initiatives. In Vietnam, for instance, they have given out scholarships, and also 24 customers benefited from first necessity products such as rice or staple food, for instance. And as for the impact side of things, here I'm talking about the social performance, but it's really difficult to consolidate impact in different social inclusion institutions because it requires a methodology that requires a lot of resources. So this is really hard to consolidate. So this is something that is currently being done at institutional level, but the main microfinance institution in Belgium. How much longer do I have? 1 minute. Oh, wow. So Microstart, a Belgian player, has showed that 70% of micro borrowers that are financed by that institution are still working in the same activity 2 years later, which is huge. Because you can all imagine that all these micro borrowers probably have startups, so they're only starting, and 2 years later they're still working, and they still have their company, which is much higher than most startups that die after a year. And thanks to this, if we look at Impact, there were around 1.6 jobs created or maintained per entrepreneur. And to talk about the environmental aspect, even if Philippe is going to cover this more broadly, but when we talk about the social aspect, we have to talk about the environment, about the protection of biodiversity. This is going to be a major element in the coming years. This is why the GEF and the BNP Paribas have contributed to the Just Institute, the creation of the Just Institute. It's a non-profit type of organization that promotes inclusive biodiversity, that will also contribute to the development of finance for climate resilience. There are concrete projects that are going to be implemented starting next year with prices indexed on climate indexes and indicators that push institutions to protect biodiversity and to foster climate change resilience, with institutions that will also assess their performance on biodiversity, amongst others, and we'll do that in Africa and South Africa. South America, rather. This is my timer, so we're very professional. We really stick to the timing. Thank you very much. Philippe, can you tell us how these institutions are managing the climate risk? I work for Crédit Agricole. We invest in about 80 microfinance companies or institutions on for impact finance in Central Asia and in Africa. Last year we conducted a study to understand what was the perception of our partners on climate change related risks, and the risks that their clients were confronted with, and we asked them how they were able to tackle this. So we surveyed about 44 microfinance institutions, 4 impact companies, and we also interviewed 7 partners. There was an article that was published. It's available on our website. And what we observed is that, first, there's a growing awareness amongst our partners on the fact that the environmental impacts and climate impacts are already present in their activities, and therefore we need to react. We wanted to understand what were the main impacts that people were perceived, and the droughts, floods were the phenomena that impacted finance institutions the most through their clients who were exposed and impacted themselves. At Crédit Agricole, of course, we work mainly with institutions that are in rural areas, so we try to support rural populations. And it's probably rural areas are probably the most impacted areas. And we see that the climate impact is 65% of our partners that are perceiving this impact already, and more specifically in Africa. We don't really have figures for Latin America. I know that BNP Paribas is present in South America, but we are not. The figures I'm going to give you are more for Africa, Asia, Central Asia, and Europe a little bit. But we can see that these institutions are already perceiving the impacts of climate change. But it's not only the climate impacts that they're perceiving, because we've realized that our Indian partner and our Bosnian partner are talking about air pollution challenges that are already having a major impact on them. We all have these images in mind of Delhi and a huge fog. So this is one of the impacts. We also have a partner in Senegal and Bangladesh that talk about the increase in the rise in the sea level. And if we want to address these challenges, we need to take into account the context of the different regions and the climate impacts that these institutions are going to face. The good news is that we have 88% of our partners that are telling us it is true that we are concerned. Yes, it is a major challenge, and yes, we need to be able to tackle this challenge. The issue is that at this stage, these partners, not all of these partners, have committed to find solutions. Around 20 to 28% of them are still not doing anything, who are saying, yes, we are impacted and we haven't started to do anything. Now, it doesn't come as a surprise, but how will institutions start responding to these challenges? There are two driving forces. Is first governance, and the governance of these institutions need to tackle this and to be willing to do it and to understand that this is not a marginal issue because it has an impact on their risk portfolio, on their customers' capacity to reimburse. So once governments understand that their performance can be hit because of that, is essential through two different players. First, the customers. The customers themselves need to make governance level of these institutions understand that they need to find other solutions, that they need to be supported. So this is where customers have a major role to play in this awareness raising. And secondly, investors such as us have a real role to play to make sure that we can come up with proposals and to implement them. Because when we ask these institutions what do they need to do more, 78% of them are telling us we need financial means that are adapted, and we need more expertise because they don't have the internal human resources that have the capacity to explain exactly how to proceed, how to tackle the challenges related to sustainable agriculture. You need capacity building. You need internal capacity. You don't not just consultants that will come temporarily from an outside firm. So the partners that have started to act started with trainings amongst their customers, so with an awareness raising campaign. So there's this pedagogical approach. The partners that have started to act have also started to exclude different types of activities such as farmers and projects that are fertilizer heavy or this type of projects. They understand that it means they may lose a few clients, but this is also up to them and us as well to support these customers transform their working methods. And we have also realized that the capacity to collect savings is a good way to mitigate risks in case of difficulties, because if you have enough savings, then you can react in case of difficulties. But we also know that some microfinance institutions don't necessarily legally have the capacity to collect savings.
So here you can see that savings accounts are very important. And we also have agricultural growth as well that can be a tool in order to help peasant farmers as well, get into the mix. I'm not going to go into the debate or the agricultural debate, but in a nutshell, we know that it's very complex. How do we overcome this? I have 30 seconds left, I believe, on the clock. So what can we do? We as investors have a role to play. To start off with, it is to us to be more and more sensitive to the question. For example, what is part of our strategic plan for 2025? How can we ensure that this is at the heart of the different interventions that we're doing? And we've started working with, and this was mentioned by Alain, we put in SRS, Sustainable Need Loans, which means they're loans that are linked to sustainable or environmental performance. We're on our first trial in India with a partner. We've got 3 indicators that were defined. And with regards to whether these objectives are met or not, a loan or a reduced loan could be offered. This is an initiative or a mechanism that we're currently working on. And in addition, we want to strengthen everything that is linked to technical assistance. Financing is the first step, but that is not the only step. We also need to provide technical assistance. We have more than 300 different instances of technical assistance, and this also allows us to look at the matter more deeply. How can we put into place an environmental strategy within companies and biodiversity? How can we ensure that companies are able to inform their employees on what they're doing? And how do they unblock other products, for example, agricultural growth, and different aspects as well. And to finish, it's also important to look at the different initiatives that were implemented with BNP Paribas, with the creation of the Just Institute. The idea that has been not only supported by the GEF, but also by IFA, that we wanted to create an initiative bringing together all of the different parties, not just from the private sector, we're also talking about the public sector, so that we can ensure that there is common thinking. What are the different types of tools that we can bring? What are the criteria, for example, to implement the SRL? What are the indicators that we should be following? These indicators, we need to adapt them to each context and to each situation. So there are lots of different sectors that we should be looking at, so that we can together support our partners and indirectly the end users, so that we're dealing with this shock that comes from exogenous factors. We are obviously are going to be having to deal with this in more detail in the upcoming years. Thank you very much, Philippe and Alain, for having spoken about the industry of inclusive finance. And now I would like to ask a question. I would like to hear your insight on what finance actors can do in order to make this impact more efficient and more resilient. Pauline, thank you very much. I would like to start by saying I know that we really honed in on inclusive financing, but impact financing is also a lot more than just inclusive financing. Let me give you a definition. I gave you a definition actually earlier, but if we take impact financing in a more general form, at the end of the day, the question is something that we need to turn on its head. It's not about how does finance impact deal with exogenous shocks, but what are the different results of this? And this is actually what you mentioned earlier. I am the General Director for Finance for Tomorrow. Finance for Tomorrow is based in Paris. We bring together lots of different financial actors, but also NGOs, think tanks and businesses. Upon the request of the minister last year, we decided to launch a group on impact finance. We wanted to develop impact finance. We started we brought together more than 100 institutions, more than 400 participants in working groups, so bringing together all of the different facets of this base. We wanted to have a definition of impact finance. Impact finance, therefore, was defined as being a strategy. It's an investment strategy for financing, looking at accelerating transformation that is just, fair and sustainable of the real economy, and the proof is in the pudding. When we think about finance, in impact finance, we've got the different pillars. We've got intentionality, additionality, and also impact. And we can also see that there is a joint research, and this over the long term, to have not only sociable but economical aspects, but also profitability. This is important. Why? Because when we think of the current context where access to financing is more complicated than it was in the past, We cannot consider that we are going to be able to transform the economy if we're just looking at financial profitability. Obviously, it goes without saying that financial profitability needs to be compatible with the objectives that are both of a social and environmental nature. Maybe this means that we need to reduce profitability with regards to the other performance indicators that were fixed. But in impact financing, we cannot not think about the profitability point of view, even though the priority needs to be given to results that are extra finance. Sure. Impact finance also needs to be part of a global reference, for example, the Sustainable Development Goals, climate goals, and biodiversity. Why? Because, as I mentioned earlier, it's about contributing to the transformation of our real economy, or our current economy rather, so that we're able to hit our objectives. We know that these different indicators are pre-existing for financing. We know that you can't evaluate them upstream. We haven't really had a poster child for these objectives. It's about developing different objectives or different investment strategies that are coherent with these objectives. And finally, when it comes to impact finance, we used to talk about responsible investment, but this is more than just responsible investment. It's more than just finding the best businesses to invest in. We're looking at transforming the economy and finding the different answers that are needed to deal with exogenous shocks, be this talking about climate change or biodiversity and so on and so forth. If we think about the value chain now, it's essential because we're looking at the marriage between a financer and then financed, which will really be transformative. What is the intentionality? What is the additionality as well? This comes through from the financer and the investor, obviously, but also the business that is being financed. Therefore, I really like what you said about support, because this was a question that I had. We are transforming the way in which we finance from a classical point of view, because by supporting the different actors, the businesses and the beneficiaries in a more significant manner, this is a couple working hand in hand together. It's a marriage. In the second facet of what we do at Finance for Tomorrow, we have a working group involving different businesses. I don't have results to share with you just yet because we're still in the starting blocks. However, the idea is to look at different indicators. How do we evaluate or assess the impact and the additionality, the intentionality, not only for the financer and the investor, but also for the business or the beneficiary. And when measuring impact, this is crucial because we know that this is what will allow us to demonstrate in a context that can be quite difficult with all of these different shocks that we're talking about. Impact will be crucial, and we won't just be looking at risk and profitability, but also what is the impact that you're looking for. I think I was faster than 9 minutes, yes. And I would also like to say that I'm going to conclude what Pauline said, but we said that we were going to be a little bit contradictory, so I'm going to play devil's advocate. So yes, I'm not here just to throw a spanner in the works, but I want to say that in addition to risk and performance and social and environmental aspects, there are other things that need to be considered. Because actually, if we were to just follow your advice, I think that we'd find ourselves at a dead end, because risk and yields are important. Social, environmental aspects need to be taken into consideration. Yes, that is a way to reduce the risk. There isn't a third leg to stand for. We can't look at yield, risk, and environmental and social aspects. This needs to come in to reduce the risk. And this is why when you're looking at the definition that gave earlier, we need financial performance on the one hand, but we also need other types of performance. We're talking about performance twice, but we're not talking about risk in your definition. However, this is the title of the conference today. We're here to speak about exogenous shocks. We're here to talk about risk. I'm obviously not going to give you the whole panorama of summer 2022 with the floods, the droughts, and so on and so forth. we saw in summer of 2022 that we really had hit the nail on the head with the physical risks that come with climate change. We spoke about weather and adverse weather, but now we're talking about physical risk that comes from this, and maybe something is not quite yet in our grasp for this summer, but if we think about the big agricultural bank in the Netherlands had to move different assets into their portfolio, and this was in the framework of IRS 16. They needed to do so because, in RFS 9 rather, because they moved to category 2, because the Dutch government had a national strategy with relation to climate change, and they decided that agriculture constituted a risk. Therefore, if it is a risk for the Netherlands, mechanically speaking, the portfolio of other banks is also at risk, and therefore they need to declassify their assets, moving their provisions, and this in the jargon is called transitional risk. Therefore, we spoke about this summer. We had a huge impact coming from this Dutch bank. We also had huge bank on transitional risk and legal risk and responsibility. Why? Because you know that there are lots of cases being brought before governments because of this type of financing. I don't have a timer, but I'm going to maybe stop here just to say that, yes, the notion of yield and risk is important. We need to think about the social and environmental risk aspects as well that come into play to reduce that risk. And this is why we're talking about exogenous shocks. Yes, I agree with you. I agree with you, Jaume. And I didn't speak about a third leg to stand on, but I said that impact financing, we're going above and beyond just managing risk. We're looking at trying to also bring solutions, and this is where it goes above the normal analysis. We're not just looking at risk management in a more traditional, but maybe we'll agree to disagree. If I may jump in here, I don't agree with this vision because actually if we think about what we're doing in social entrepreneurship, I mentioned earlier that at BNP Paribas we have lots of different social businesses, but yields or turnover is not what most businesses are looking for. Now they're looking at the social impact, the environmental impact that they're generating, and here it's completely changed because the yield is a means to generate an impact. Here we're in a completely different ballpark now. Yes, but look at the figures behind you. It's a graph behind you. You can see that these equity to assets rates are something that are fixed. Therefore, no, it's not just fixed rates. And so what we're saying in the sector is that it's a means to an end, right, which is impact, yes. But this is the difference of the industry, the impact industry, and an industry that is not obliged to just be looking at the bottom line. Raphael, away you go. I didn't want to interrupt the debate. Good afternoon, everyone. My name is Raphael Ara. I work for XEPA. We are a business, and we mainly look at two different activities. We consulting for businesses and financial institutions and investors, and on the other side we develop solutions and programs for small-scale or smallholder farmers rather at the very beginning of the supply chain. We're looking at digital solutions, for example. We look at low-tech solutions, and we also look at impact finance, carbon finance, and I hope microfinance as well. Therefore, we have a couple of examples as well to share with our work with startups. So it was just an introductory note. And to bounce off the other points that have been evoked within the framework of this debate, I think that the jury's still out on this one. We have, on the one hand, the societal and environmental impacts, and then the positive impact as well from impact finance. We have a new concept that's emerging as well that brings the two together. It is about regenerative economies and investments, which means that you are looking to have a multi-dimensional impact to regenerate or restitute social and environmental conditions, but then also, in a different vein, looking at a holistic approach to better manage social environmental risks. In my opinion, the answer lies therein. Why? Because to a certain extent, it's not because you're looking to have positive impact that you have good risk management. A developer of renewable energies, for example, could have faulty systems, which means that they've put wind turbines on indigenous lands, for example. It's not because you've got a good intention, it's not because you're looking at impact that the focus on the impact allows us to best or better manage these risks. Afterwards, maybe I could answer the initial question that was put forward. How can impact finance transform or improve so that we can better deal with exogenous shocks? We spoke about climate change. We also spoke about the crisis in Ukraine, which is a social risk as well as being an environmental risk. And I think that we need to work across all of the different components. Finance isn't just about looking at financial practices, but agricultural practices. How can you regenerate soil so that it is better prepared for climate shock? And not only for the finance, but the financiers. How can you work across the board in order to engender certain reactions from investors who are going to participate, work with the different beneficiaries within different infrastructure? How can we really make a difference? How can we have an impact that will help us deal with exogenous shocks? In addition, we're talking about risk management here. There are lots of different tools out there looking at how can my activity, or what is the impact of my activity on the environment? What can I do tomorrow to ensure that I'm preserving biodiversity, but also saving those species that are threatened or endangered? If we think about this, when developing different policies, obviously it will help us to reduce the negative impact on the environment. We also need to think about the different adaptations and the changes that need to be made so that we're bringing together both financial objectives but also not having a detrimental impact on the environment. What about bringing together coalitions of different stakeholders, bringing together private and public stakeholders? We know that this is difficult. We know that even if we need this, we know that finance took a hit in 2021, and now we need to, especially from a sustainable development point of view, and we want to bring together core players from CSOs, investors, to be as transparent as possible with the initial objectives. How can we adapt to the exogenous shocks of tomorrow so that these coalitions can have an impact from a financial point of view? In order to be adaptable, we know that one of the main points of leverage is innovation and social innovation. If we're looking for impact, be we talking about attracting talents or creativity, innovation, energy, the impetus that we're giving, even if this means coming to forums such as Convergence, here or in other countries, there is energy, there is an impetus, once again, that means that when we're looking for impact, this is something that is part of our rationale behind social innovation. And this in itself is an element of resilience. Thank you. Thank you very much, Raphaël. Jérôme. So, impact is an ingredient for good risk management. We've also got risk management to meet ultimate goals for impact. Okay, shed some light on this, and maybe you could share your 2 pennies. Thank you very much. And just prior to responding to this, KPMG is also a company that is looking, we think about the big four as being the entities, the international entities, but actually KPMG also took a decision in June of this year to transform in a low emission company. And if I take the words of Jiao, who is the head of finance for tomorrow, it is a company for impact, which means that the objective is to have an impact. And rightly so, the idea behind the transformation of KPMG is to completely shift the turnover of our company. Obviously, we will still be an accounting firm, an auditing firm, a consulting firm, but all of the consulting activities need to migrate and this over the course of the next 3 years. Maybe this is a little bit presumptuous, but 80% on USG. Why? Because we think that we are now we're part and parcel of a post-liberal economy. Therefore, we need to look at the different aspects of ESG, the end of complete dismissal of societal issues, and also the government's approach that there are no alternatives. But yes, there is an alternative. There is another way of making money, and this with a lower impact on the society. This is the ambition of KPMG France. We want to completely shift where our revenue is coming from. We are very aware of the risk, the social risk, the environmental risk, and obviously this is a door that has already been opened for all of you who already work for these big groups. You know that you are working day in, day out to secure your supply chains. And I know that a lot of you are looking at the business of sand, and this is something that conditions the whole of our economy. The Swiss have ensured that sand is not leaving Switzerland anymore. But what are they doing? They're covering their back. The idea is to find the cheapest supplier. And instead of finding the cheapest supplier, once you have that cheapest supplier, it's about getting your hand on them and then keeping them. We have, I don't know what you call them, but we know that this is important, and they're looking at even securing their human resources. Their financial departments want to ensure that their financing is also secured. Everyone is trying to work on ESG, and lots of financial departments also consider that it is such an important strategy that it needs to be part of the financial department in itself. So there you go, just to answer your question. What is the impact, environmental and social impact? This is at the heart of business as it will be conducted tomorrow, and part of the ESG transformation of these businesses. If I can maybe jump in here, I think that we shouldn't get things mixed up. Impact and risk and ESG risk management are not the same thing. ESG is there's a document every single day. ESG is nonsense. But why? It's because people tend to get it mixed up with risk management. Impact is an ambition. Impact is transformation. If we think about 10 or 15 years' time from now, we're not just talking about risk management, but we're also talking about what we need to do. Yes, I completely agree. And the definition of that was given by the Google Plus, the negative and exogenous shocks that we're talking about, these are the foundations or the basis that we need to be working on. And impact goes above and beyond this. Yes, we have risk management for environmental risk, but this should be the baseline rather than the framework. I'm a little bit uncomfortable with Jérôme. He keeps talking about risk, and risk. Why? Because on a personal note, I think that we're here. Why are we here? And what are we looking for? That should be the baseline for us. If we're just trying to protect ourselves, protect our own risk, or protect our own investment, I think that there will be nothing new coming onto the table. If we're here to support, and I'm talking about what we do with microfinance, our customers, the businesses that we work with, if we're here to support them, not with risk to say, okay, we need them to be less risky so that we can invest them. No, we want to support them so that they are able to deal with the new risks, the climate risks or others, so that they're able to improve their resilience, so that they can be stronger to the shocks that they're confronted with. That's what we're here for. And this maybe means that we need to take more risk. And we need to take more risk to ensure that the impact that we will have is a positive impact. If not, we're going to find ourselves in situations where as soon as there will be a situation that is too risky, we will withdraw. And you've got greenwashing and impact washing, and that's exactly what we're talking about here. These are great words, but as soon as there is an issue, as soon as there is a concern, as soon as there is a hiccup, we want to withdraw and protect ourselves. I think that we need to go back to the heart of our analysis, the customers and clients that we're working with, and how can we improve the impact that we have so that they're the right life conditions, so that they're able to resist even if we need to take a little more risks and even if we're losing a little bit of money. But that's just my opinion. A capacity to resist, a resilience. I think that we're talking about the same concept, no? It's at the end of the day, it's about changing the way things that we're doing. It's not about protecting ourselves or protecting our investments. Even from a marketing point of view and industrial point of view, everyone is having to change their business model. And it's not just about putting up shields and putting up walls against tsunamis and raising the roof against flooding. No, that's not what they're doing. That's not the objective at all here. It's about continuing your activity. It's about changing your business model. That's what we're currently seeing, so that there is an environmental and social impact that is a lot stronger than it is currently. That's why I wanted to bounce off the resilience. Resilience was the key word here, and exogenous shocks as well. I'm not here to defend ESL or whatever else, or ISL rather, or whatever else you might think, but I'm talking about the fact that we're all here to think about impact finance and how can we have impact finance or credit finance. And even with SMEs, we still have impact, and we're asking even the smallest of businesses to show how their business model has evolved to have impact finance. And that's what then determines the price of their credit. It's not just about financial movement here. It's not just inclusive finance or microfinance. It is mainstream financing with an objective to change the business model.
Well, to bounce back off what you were saying, in that case, we don't only include impact finance in risk management, but we also include it if we do. If we want to do impact finance, we need to assess the impact that we want to generate and see whether this impact is expected. Knowing that societies are expecting large companies to generate impact, simply announcing that we have generated X amount of yield, X amount of profits is not sufficient anymore. This is not what people are looking for anymore, especially because there are a lot of social investors, impact investors, that are looking for this type of companies with impact or with an impact mandate. And this is why we need to change our model. And the risk impact ratio is not as interesting. So the impact yield ratio is not relevant anymore, because I think it's impact yield. and social aspects that is more relevant. This is the model that we need. Now's the time for questions. Thank you. There's a future exogenous shock that is coming up, namely the rise in interest rates. Do you believe that different institutions, customers will have to bear the burden for this shock when they're already carrying the burden of the social and environmental impact of climate change, amongst others? Well, for the interest rates that are going to increase, microfinance institutions, for the most part, don't have access to reserves. Therefore, they need to get financing from financiers such as us, because most of them are not banks. So they don't have they have this structural dependence based on the loans that they're going to grant, because they don't have these reserves. Now, what we'll look at is the margin that they want to get from these financing structures to offer a financial loan to the borrower. And this is the margin that they need to limit. They're going to have to limit this margin. And what we are going to do, and this is what we were discussing with Philippe, for SLLs, the sustainability linked loan, we are going to promote and foster these institutions, the institutions that want to generate impact at environmental level, biodiversity level, by proposing specific lines with a much lower interest rate than what we are used to offering, if providing that they reach some objectives, environmental and climate related criteria that will be assessed by an independent assessor. Before I came here, I was in a meeting on this topic, and I wish I could give you a clear answer, and I could tell you that we are going to find a business model that will allow us to offset these risks of increased interest rates. At the foundation, we have an allowance by the Crédit Agricole. We manage 50 million euros, but that were borrowed from different institutions, and we are renewing the lines, a line that for which the base point increased by 300% over the weekend. So it's complicated to strike a balance between having the capacity to maintain relevant rates for our partners, and at the same time to make sure that our partners don't find themselves in a situation where their resources don't increase significantly, and that these increase does not impact the customers too much. And there's a timeline here that we need to manage, because it was very recent. The foundation was created in 2008, and it's the very first time that we're confronted with this. We've never had this issue in the past. Now, how can we respond to that in the long term? How can we stabilize things in the mid-term to find funding levels that are reasonable enough? I don't have an answer. I hope that the situation will stabilize soon. But this is a very complex situation that we need to deal with. And it is true that we have this willpower. For now, we haven't changed our pricing. This is our decision for the coming weeks. But I won't be able to tell you that whether we can change this, whether we'll have to change this in the near future or not. But I understand that it can be a difficult situation for customers and for customers' the customers of the institutions that we work with. Thank you for your different contributions. I would like to discuss the perspective, be it the risk approach or performance. approach. I think that this is a fundamental discussion that we should have in the financial sector. There's an additional idea that I would like to submit. Of course, you should understand the nuances because I know that this change in model is going to come up with opportunities, including financial opportunities. And I know that we shouldn't go back to this vicious circle of trying to look for profit, but at the same time, there will be environmental behemoths that are going to make more and more profit because there's more and more demand. But there's a value in the financial performance. I think that these investment strategies can be profitable. Is this something that you have looked into? Are there assessments on these potential financial opportunities? And again, I don't want to shift the debate towards profit, but I still think that this is a discussion that we should have. Thank you. I will try to answer that question, even if I'm slightly off topic. I'll try. I'm not sure that there were any assessments per se, but if we talk about risks, it also comes with opportunities in terms of the reporting requirements that are being standardized at European and international level. And it is true that these opportunities exist. And we are asking companies to be accountable of that. And I'm not sure that the potential right now, again, it really depends on what we're talking about, because there probably have been estimates. But it is something that needs to be taken into account. And this is also why in the definition of that we use, the notion of profitability is something that we need to focus on. And of course, I know that you're probably thinking that this is all I'm talking about, because I do know that the notion of profitability should not prevail over performance. But there's got to be some sort of profitability, so the notion of opportunity needs to be factored in. I have a good example to give you to illustrate what you're saying. The water fund it's a fund specifically for water. It's a BNP initiative, and at one point BNP advertised for investments on water, and they were saying that the profitability will be better because everyone's looking for water. It was not always well understood by some NGOs that thought that it was a way to speculate on the shortage in resources and on the fact that some people don't have access to water. But it wasn't the goal. It was an infrastructure that aimed at bringing water to areas of the world where water is scarce. But it is true that investing, having an impact, can also generate profitability. Now, is this profitability a normal profit or an excess of profit? Is this a question for me? Yes. Is this getting a financial profit from an impact project? Is it an excess in profit? Is it something that should be considered as regular profit? For the waterfront, I have no idea, so I wouldn't be able to answer anything on that project. But what I can say, however, is that we commit on transitions. Coal, for instance, BNP Paribas has made clear commitments on that in order to step away from coal investments. Large mining groups are supported for the ones that want towards diversification. So we are supporting them in their transition to move away from these sources of energy towards clean and renewable energy. So this is how we support this transition, because we want to step away from these financing. We want to finance clean and renewable energy projects. Thank you very much. There were estimates on the financing of the SDGs between 3 and 5 millions of euros for the SDGs. I think we've missed an opportunity with the low interest rates that we could have used. to direct this money towards financing the SDGs. That was probably related to because of the inertia and the context, but we know that the needs exist. We were talking about energy transition, but I think we should also think about other instruments. And we should also take our inspiration from emerging country solutions that could be relevant for us as well. We should use public funds and institution funds as a way to de-risk projects. And having concessional loans with different conditions to make sure that then private resources and money be redirected towards the fulfillment of the SDGs. Thank you very much to all five of you. My name is Antoine Duchamp from Mesocredit. Mesocredit was one of the first, was the product of one of the first convergence forums. Philippe was a witness of that. And I'm actually really surprised because at the time someone told me, oh, you need to go and see CB, Cerise. And at the same time, people were really happy because the main traditional structures that you are presenting, KPMG, etc., they're all convinced and telling us that they're going to continue in the same path and they're going to transform themselves, which is a major progress for scaling up, etc. But I'd like to have your point of view. Wouldn't you be more efficient with all the technical resources that you have, the studies that you have, the human resources that you have? And I know that with Mesocredit you do that BNP in Belgium, but could you not transform your other entities? So individual players, there are social entrepreneurs that take the floor at convergence events every year. They have this naivety. They're not yet involved in this type of debates, and they're still alive. They're making money. I'm one of them. So wouldn't you like to have a lever impact with funds such as mine? Would you not invest in smaller funds rather than trying to reform your large groups? Because there's this sense of urgency. We need to act fast. You know that your structures are huge. I'm being a little terse here, but you've seen banks merging, new players. I don't know if in 20 years time we'll still have the same debate. So first, I want to say you have the means, the tools, but maybe you should bet on newcomers, especially in developed countries. Well, as for BNP Paribas, I don't think that we're just cruising. We really stepped into the scene a few years ago. And as you may know, we work in social entrepreneurship in France. Go to the Act for Impact corner that is here to meet social entrepreneurs, because we have portfolio managers in the French network and also outside with Italy, Morocco, Belgium. We have portfolio directors that specialize in social entrepreneurs. They know exactly how to assess their potential and how to manage them. This is something that we're doing more and more every year. We have now more than 2.3 billion euros in social project worth of projects. So this figure is growing year after year, and it's not a problem for us to rely on other players when we can't do something. For instance, when we do social entrepreneurship, we resort to and we rely on retail bank. When we're in a country where we don't have network banks, we can't offer the same services. When we only have investment banks, for instance, we can't be present and ask this type of companies to this type of branches to support SMEs. This is not possible. So what we do is that we finance microfinance institutions or networks, or funds even, to be present in these countries where we don't have any structure. And recently, in the past 2 to 3 years, we've had in past impact investing an envelope of money allocated by the general director to support impact companies on the social and environmental level, and we have an envelope dedicated to this type of projects. So I'd say that we are really on an upward trend at BNP Paribas on these issues. Well, we don't have a mandate to work in Europe or in France, to be very clear. The Grameen Foundation at Crédit Agricole is very independent from Crédit Agricole. We're completely different in our business model from BNP Paribas. So Crédit Agricole is in charge of supporting this type of initiative. So I can't really answer this question. I don't have any visibility. The group is large enough to do different actions, but I don't necessarily have the visibility to say that. I know that the group does a lot, but they don't necessarily talk a lot about their actions. Now, locally, in Africa, Asia, etc., every year we partner up with new institutions and new in our portfolio. We have fintechs also that we work with in Africa, in Kenya, in India, etc. And I also think that it's a sector where we need to act quickly, and people can feel this. The only challenge that we have is the difficulty that the partners that we support, the social companies, impact companies, how can we support these companies? As I was saying, investment, funding is good, but it's not enough. We need to step up. We need to be able to support these players with technical assistance, and we need to find the financing systems that are relevant for these structures. And this is where public financing and public strategies that are sometimes different from one context to the other. We work with refugees, for instance, and these are new players, new challenges that we're taking on that we are faced with. But this is also where I think that the creation of the Just Institute is very relevant, because it brings about this common reflection that we want to have with different players on biodiversity and environmental challenges, for instance. And I know that this was already talked about for the reflection in France. This is not something that we can do in silo. We need to work hand in hand. We need to bring together the different positive energies that are already working on these, this is only how we will be able to scale up. But if we don't work with the people in the field, nothing will be possible. So we need to support these players as much as possible, these local players.
I would also like to jump in here just to plug the Impact tank with Agnès Audier. You'll be able to find on the 4th of August in Le Monde, there was an article by Agnès and Pauline as well, because she's the president of finance for tomorrow. And they actually wrote an article, a column, on the fact that there is a common definition of social commitment. What is impact and how do you measure impact as well? Therefore, to everyone needs to participate to the works of the Impact tank so that we're able to get a better idea of what the definition of this will be and how can we measure this. This is a call that was launched very loud and clear by Agnès. And yes, I said finance for tomorrow. Now I mentioned you. You're saying come and work for Impact. I'm saying come and work for finance for tomorrow. Yes, in the framework of the Impact tank, because I believe that there's really a necessity to find common definitions, common denominators in the world of ESG and generally speaking as well. That was it. That was me plugging my tank. I have a question. Earlier, Philippe mentioned about governance, said that we needed governance, but why can you not provide governance with the striking power that you have, as was mentioned earlier? I am very humble. So governance, what is governance? Governance is each institution has their own governance, and what is fundamental here is that if you aren't able to convince, we are not going to impose anything. The foundation isn't going to impose anything on the people that we're working with. We will give strategic guidance, but the strategic orientation, that isn't what we're there to do. We're there to support you, but the strategic choices that need to be made, and microfinance for KPMG is the same. These are autonomous agencies that have their own vision, their own approach. And what is important here to understand is to see how we can try to sensitize, but even raise an awareness with the different actors. For example, KPMG, they are influenced, and there was a strategic reflection with regards to the world around them and the different choices that can be taken. And this was maybe a little bit surprising, but we are delighted to see this change. That's the difference here. How can we help governance and in businesses to be more aware about these different questions, but also to take the measures necessary to ensure that there is positive impact? I think that this is fundamental. Why? Because if you come across these types of questions, when you meet directors, heads of institutions, when you talk about biodiversity or climate change, it's as if nothing's happening. And that's something that requires time. It requires us to look at relevance. And once you've got relevance, how can you convince other people? That's what we've been trying to do with this type of event, and also with going out and meeting our partners. I just have an example with regards to this. I don't think we've got the same understanding of what governance is. For example, I know that old habits die hard, but internally you may have tools. You spoke about the fact that people don't have the pedagogical approach for that, and that's what Mr. Foncier mentioned earlier. The rate of return could decrease. We know that BNP Paribas in the past used to invest in oil and gas companies, but maybe investing in smaller companies. I'm not going to, I can't say what BNP Paribas should be doing. Maybe he's better placed to do that than I am. But yes, it's the approach that we have with the SLL. I'm just throwing it out there for exchange. But this is something that's more attractive, yes. But we need to look at there being different impact indicators that need to be looked at and implemented. And that's something that's easier said than done. How can we define what the indicators are? How can we follow up on these indicators? How are we all in agreement on what these indicators are? How will we assess them? Who will assess them? These are different processes that are very complicated, and they're time-consuming as well. And I think that the steps we have started taking the steps that are necessary, but it is a long and arduous road. And here I think that when you're talking about zero interest rates, it's not because I'm a banker that I'm telling you this, but we are looking at impact finance. We're not looking at philanthropic movements. Therefore, this is a virtuous circle, and we want to have impact. But with impact, you can have return. And I know that we keep talking about KPMG, but we can control risk. But it isn't. We're not here to finance at zero interest rates. I'm not saying that it needs to be zero interest rate. I'm saying that from my experience, I know that there are startups who have beautiful projects. They've got very interesting projects, but they fall at the first hurdle because they're not able to have financing for their projects. And this, for me, is an issue. So I know that from my own experience, customers who have big budgets, they often go further than those who have no budget, even though the project might be just as virtuous. And for me, the banker is the one stopping this. No, it's not just the banker, it's the business model as well. It's the structure that will be presented. It is management. There are lots of different prisms. When we look at a project and decide whether to finance a project, it's not just about it's not just the banker saying yes or no and that's it. You also need to know whether the project in itself is solid. And this is what we're trying to do. This is what we've been training our employees to do as well, so that they're able to help the highest number of social entrepreneurs. Thank you very much. I think we have enough time for one last question if there is one. Julien has put himself forward. If not, is there anyone else who hasn't yet taken the floor? I'm sorry, you've already taken the floor, so we'll give the microphone to someone else. Good afternoon. Thank you very much to 5 of you. I would like you to clarify one thing. The sustainability-linked loan, the SLL that you mentioned, with indicators, have you got any targets, or how do you assess these elements? Have you seen a shift since the SLLs were implemented, and do they make sense? Can we trust in them? Can we really assess the impact of a project? It's about evaluating the impact of a business, this credit. They're structured on revolving facilities, so they're credit lines that are global for a company, where we look at financing the company in its globality. And I think about Total, for example, with Patrick Gouillani, who pledged 2 years ago to transform the whole of debt into SLL bonds. And the speaker is now giving the French translation, which also answers your question about French companies. And the market is an emerging market. Therefore, we would need to wait for the different objectives to come out 3 or 5 years to see if they've been hit or not. And then, yes, at this point, we'll see. But the movement has started, and I believe that in Paris, it is rather a wager that I've launched. And I believe that by 2030, there will be no debt that won't be linked to sustainable goals. You won't be able to just have classical debt or have classical credit. All bonds will be linked to sustainable objectives or goals and targets. And we'll see then whether the proof is really in the pudding. But it's a little bit too early now for us to have global conclusions from the market to know whether this has worked, whether this is relevant. For example, a company such as Total, I don't have anything for or against Total, but it's not just about doing something for the sake of it. They're not just doing it for the buzz. It's a complete change of mindset. Thank you very much. Alain, Philippe, Pauline, Jérôme, Raphaël, thank you very much. Thank you for your questions as well. We have learnt a lot. We've spoken about impact, risk management. We have not always been in agreement. I've learnt a lot. Thank you very much. And I look forward for us to work together so that impact finance is something that is necessary for a better future. Thank you very much.